Good morning. Good morning, all you magnificent melon heads of the world. I hope you guys are well, and happy Thursday. Today's April 18th, 2024. And as I'm going through the headlines this morning, I'm seeing a consistent theme touching virtually every single story I'm going to talk to you guys about today. And that is this story of affordability showing up in these quarterly earnings reports from these big, massive companies. In particular, home affordability, auto affordability, and then declines in discretionary consumer spending elsewhere. It is all over the place. The bifurcated economy, if you will, all these muckety mucks on CNBC, Bloomberg, a lot of these other, these big Keynesian finance channels that are out there. I keep hearing this phrase, bad vibes, being thrown around. Number one, it makes you sound so cool and so hip to say vibes. Oh, look how edgy they are. They said vibes. Trying to gaslight the hell out of people and say, the problem with the economy isn't the economy. The problem is you. And the Wall Street Journal last week or 2 weeks ago, that op-ed by Greg Ip actually literally said that. The problem with the economy is you, not the economy. My God, get outside, touch some grass, people. Well, you can see it. The higher interest rates, the higher inflation, and the lack of increases in wages to go along with that has created an economy that most people just can't afford the basics of life anymore. They're having to go into debt. They're having to borrow all this BNPL loans and mortgage their futures and credit card debts just to make ends meet. But at the same time, the people in the top 20% or top 10%, they're just sitting there humming along like, oh, everything's great. My 401k is way up. All my stock holdings are way up. My assets are at all-time highs. My Bitcoin is up. My gold is up. My stocks are up. Well, that's great. But 80% of people don't own that stuff. And the reason why all your assets are up is because of the same inflation that is crushing the 80% of everybody else. So don't sit there and say, what's the matter with all you guys? I'm rich. Talk about out of touch. You see that everywhere in the economy. Case in point, this morning, Ally financial results were reported. Now, Ally is not the biggest bank in the country. Right? It's not a huge outfit, nowhere near the size of like a JP Morgan. Yes, it is technically a bank, but banking is really a small portion of Ally's business. Ally's bread and butter is auto financing. That's where they live. And man, Ally earnings were abysmal today, down 56% year over year. Ally's profits, massive decline in their profits. Net interest margins getting squeezed. We've seen this with all of the banks. Higher rates are causing deposits to leave these banks and go for higher yielding money market funds. So they're having to pay higher interest rates. At the same time, they're issuing fewer loans. Now, why would Ally Financial be issuing fewer loans? Because people can't afford cars. That's why. We see this data all over the place. Declines in EV prices, plans to cancel EV factories. Even this morning, we got data out of Europe showing declines across the board in auto sales in Europe because people just can't afford cars. And well, if your business is making loans to people so they can afford cars, guess what? Your earnings are going to get crushed. And we see that in Ally Financial earnings today. We also saw the automotive issue show up a little bit in the Taiwan Semiconductor earnings. They just came out today. All right. Now, case in point, Taiwan Semiconductor earnings, they were good. All right. Beat expectations, good growth, right? Revenue up 16.5% year over year. Profits up 8.9% year over year, driven largely by AI. You're going to hear a lot of talk about, oh my God, the insatiable demand. It's very, very strong for AI chips. We get it. We've heard that before. Nothing new there. But buried within the Taiwan Semiconductor earnings, they're mentioning awful lot that you hear talk about smartphone seasonality, which means people aren't buying phones. And yeah, that's somewhat accurate. There has been a little bit of a seasonality to smartphones over the years. The demand tends to come in waves. But this is more than seasonality, the decline in smartphones. Number one, the phones just aren't that good anymore. Or I should say the phones are good, but they're not improving like they used to. Oh, Apple added another camera and, it's got an extra megapixel than it used to. It's not the big innovations that we used to get in smartphones that would drive this big demand for them, combined with the fact that people don't want to finance a $1,500 phone or a $2,000 phone, pay for it for the next 3 years when it's only going to last 2. And so smartphone demand is down. That's hitting Taiwan Semi's earnings a little bit, offsetting some of those glorious AI numbers. And Taiwan Semi also mentioned an expected decline in demand for auto chips. There's those autos again showing up, a decline in the demand for chips for autos. So Taiwan Semi's earnings were pretty good. They guided for revenue growth in the mid-20s, low to mid-20s this year. So that's good, but it's not great. And another interesting thing is yesterday we had a pretty solid sell-off in the AI stocks yesterday. Notably, ARM Holdings sold off more than 10% yesterday. Now, that's a big SoftBank name. ARM Holdings was trading at just a ridiculous valuation. It was like 1,250 times earnings ARM Holdings was selling at. It's now trading at a much more modest 1,195 times earnings. So, hey, it's a real value stock there. But ARM Holdings is not really responding today. Right? The semiconductor stocks, they sold off. The AI stocks sold off really hard on those ASML earnings yesterday. The semiconductor equipment manufacturer, they posted earnings that weren't so good. ARM Holdings sold off. NVIDIA went along for the ride, down 3% and change. Supermicro sold off. AMD, all the semiconductor stocks, especially the AI stocks, sold off low single-digit percentages yesterday, while ARM Holdings sold off big time. Now, you would think these glorious numbers from Taiwan Semiconductor showing, hey, insatiable demand, very, very strong. You think that would be enough to reverse the sell-off in these AI names from yesterday, but we're not seeing that. We do get a little bit of green in the AI names. NVIDIA's up 1% and change today. ARM Holdings, I think, was the last I looked, it was up a fraction of a percent. But as of 9 a.m. this morning when I went live, we're not getting a big reversal in the AI stocks of yesterday's sell-off. So that's telling me that the investors are looking at these Taiwan Semiconductor earnings and they're saying, CNBC headlines and everything aside, they're just not that good. Okay, 20% year-over-year revenue growth is pretty good. Any other industry, that's really good. But when you are priced for absolute perfection, like a lot of these AI stocks are, you're looking for bigger numbers than that. So they didn't need good. They needed great. They didn't get great. Taiwan Semi earnings were just good. And in that regard, they were mixed. And when you factor in the declines in the autos and the declines in the smartphone demand, it's actually not all that great for Taiwan Semiconductor. Also, big story this morning in real estate, and this one really surprised me. D.R. Horton's earnings came out. D.R. Horton's earnings were incredible. Revenue up 14.2%. The number of new homes ordered up 14.3%. The value of new homes ordered up 17.4%. When the value of the homes is rising faster than the number of new homes, that means the price of the new homes is rising faster. 4.8% year-over-year increase in the price of new homes for this quarter for D.R. Horton. Guys, housing prices continue to defy gravity. They're still going up. The supply just isn't there, and so the home builders are doing great. And we got more data to support that from Redfin this morning. Redfin says the median U.S. home sale price rose 5% for the 4 weeks ending April 14th. Homes are trending higher. We've got more shelter inflation. And, the Fed and everybody is sitting there waiting for the rent inflation to start coming in, the owner's equivalent rent inflation. And yes, that should be coming down any day now because asking rents are down versus a year ago. But now home prices are rising again, and they're starting to rise faster again, which means the next wave of rent increases is just around the corner. So this is saying to me, more inflation just around the corner. And, keep in mind, guys, home prices here, they're only a few $1,000s short of their all-time highs from back in 2022. But the interest rates, mortgage rates versus the middle of 2022 are more than double what they were. Back in 2022, you could still get a mortgage for 3%. Now we're talking 7.5%, and the prices have risen. That means median monthly payment, slightly different than average. The median monthly payment is up 11% year over year. But remember, guys, wages have only risen about 4% year over year. So that means the average person is spending an even bigger chunk of their income just on shelter, which means they don't have money to spend on things like cars, Ally Financial earnings, Taiwan Semiconductor earnings, or smartphones. Decline in seasonality for smartphone chips. The affordability crisis is squeezing the hell out of people. And there's another obscure data point from CoStar this morning about hotel vacancies. More than 50% of the budget hotel rooms in America are vacant because poor people can't afford to travel. So tell me again about the bad economic vibes. Tell me again how the problem isn't the economy. The problem is you, right? You can't afford to travel. You can't afford a car. You can barely afford your rent. All the hotel rooms you typically stay at are vacant. But the problem is just your bad vibes. You just spend too much time on social media. Stop listening to Jack and all of his numbers and his data points. Just listen to what Jim Cramer tells you. And Jim Cramer tells you, soft landing, everything is great, best economy ever. Right? Isn't that how that works? Why don't we shrink my big melon of a head and let's get into the data this morning. Guys, don't forget that like button and the subscribe button right next to it and the notification bell. It really helps me with the YouTube algorithm, and we do this every day. So if you're new here, hit that subscribe button and have your coffee with the melon heads as we go through the markets. Right now, the S&P 500 is up 11 points, almost 12 points, about a quarter of 1% higher this morning. The Dow is up 126.9 points, about a third of 1% higher. And the NASDAQ is up 40 points, or a quarter of 1% higher. That's after a bit of a sell-off in tech yesterday, again, led by the AI stocks. They are up a little bit this morning, but surprisingly very little. Maybe they rally later in the day, maybe not. But so far, those Taiwan Semiconductor earnings have not been enough to really move the needle on the AI stocks. Meanwhile, the U.S. dollar is pretty much unchanged here at 105.96. That's up 1 basis point. We gave up that 106 level yesterday. We got some dovish with an asterisk comments from the European Central Bank yesterday saying we're probably going to cut rates in June unless blah, blah, blah. And I guess it was that unless was viewed as a mildly hawkish from the ECB. That caused a bit of a decline in the U.S. dollar versus the euro yesterday, which took the Dixie down. The euro is the biggest contributor to the Dixie. Looking over at the bond market here, we've got yields are largely higher. The 30-year Treasury, 4.722. That's up 2 points and change. The 10-year is at 4.616. That's up 3 basis points. It was down a couple more yesterday, but still holding that 4.6 level. 2-year Treasury, 4.960. That's up almost 3 points. And the 1 month is at 5.393. Shifting over to commodities, we've got gold and silver are higher again this morning. June gold futures, 2,398. That's up about $10 or 0.4%. May silver futures at 28.47. That's up 7 cents or a quarter of 1% this morning. Platinum's down 0.5%. Palladium's up 1.5%. And West Texas Intermediate crude oil at 82.95, up just 26 cents this morning. Oil's seen a little bit of a reversal in the last week or so. We've gone from the high 80s to the low 80s. I guess there was a lot of buildup in price anticipating more widespread violence in the Middle East, and the Iranians' response was somewhat muted. I use that term lightly, and the Israelis are yet to respond, and so oil is just kind of hovering here in the 80s. They are expecting some kind of military action from the Israelis over the weekend. It is ridiculous how scripted and just like posing for the cameras this conflict has been. It seems like this war is being fought in the press, which I guess is better to fight a war in the press than actually have people bludgeoning each other to death with their bare hands. But still, it's stupid the way they're doing this. Anyways, I guess I'll just move on from that topic. Let's look at that silver chart, guys. That all-important 28.30 level in my favorite of the shinies. We closed below it yesterday, back above it today. Again, silver really struggling at this resistance level. And if we're going to zoom all the way out, the reason I emphasize this is because this level was very important during the silver squeeze. That was the intraday high during the silver squeeze. And we failed to break above that despite repeated attempts throughout 2021. Now here we are right about that same level running into resistance. If we break above this, guys, then the sky is the limit. We're talking 2011 highs in play, and that is a lot higher from here. Moving on to Bitcoin, the sell-off in Bitcoin was pretty brutal again yesterday. We very briefly, we were below 60,000, bounced up above that, currently trading at $62,180 on Coinbase. That's up about $900 from the low yesterday. It's been a rough couple of weeks for Bitcoin. Now, there's some interesting data we got here about the Bitcoin ETFs. First of all, Swan is telling us that Bitcoin ETFs saw net outflows of $165 million yesterday. So, you know, that FOMO into Bitcoin ETFs, it looks like that is over here. And actually, we had a decent amount of money leaving yesterday, led mostly by Grayscale with $133 million. But I'd also add that we saw outflows from both the Bitwise and the ARK ETFs yesterday as well. So it's not just money leaving Grayscale and flowing into the other ones. Now it actually goes up and down day in and day out. And I saw this chart on X. Also, this is a pretty good one. Shout out to my moderator, Mish, who found this one. This is showing total Bitcoin ETF holdings over time, going all the way back to the initial announcement of the approval. Now, the blue line down here, that's your Grayscale GBTC. That was the only game in town for a while. That one has fallen as the other ETFs have captured market share. But I want to draw your attention to the total level, the top of this chart, right? You had that initial surge of money into Bitcoin ETFs, and the Bitcoin price rallied like crazy. And then it looks like that peaked right around mid-March, and it hasn't risen net. Like on the whole, it hasn't risen since mid-March here. We've had money leaving Grayscale, flowing into the others. Money leaves one into another one, back and forth. But the absolute level of money in Bitcoin ETFs has been unchanged here for about a month. So that means the initial excitement, that initial hysteria over Bitcoin ETF approvals, it's in the rearview mirror, guys. That is over. Maybe these approvals in Hong Kong that everybody's expecting, maybe that will add to a little bit more institutional money flowing in. But it looks like for the time being, that ETF hysteria is done. And this is the level we're going to trade at. That is until the next halving cycle, which is just one day, 16 hours away. The halving happens in a little over a day. This is not a big event. It's not like the buzzer goes off and Bitcoin price skyrockets. But historically, the 18 months following a halving have seen almost all of the price gains in Bitcoin. Big things happen after a halving. Will this time be different? I don't know, because we never had the ETF phenomenon. That is a new variable in this equation. So nobody really knows how Bitcoin is going to react to this halving now that the institutional money is involved. But we'll see how that one goes. Now let's talk a little bit about Ally Financial. This is the big one today. Again, not a huge company. Ally's got a market cap of $11 billion. All right. So as far as banks go, it's far from a giant. But this is the biggest player in auto financing, and that's a big deal. This is your inflation, your affordability crisis starting to show up in the financial system. Ally Financial's quarterly profit tumbles on higher provisions. Ally Financial's profit fell short of estimates as the lender struggled to fully benefit from recovering U.S. auto sales. Guys, that phrase, recovering U.S. auto sales, I don't know where they get that from. Everything I've been reading is showing the auto market is in big trouble here. Dealer inventories are rising and prices are, well, electric vehicle prices are falling because people just don't want to buy them. The payments are astronomically high because of higher rates. But I guess if you compare it to the absolute worst point in the vid when the pandemic was at its peak, then yes, I guess you could refer to it as recovering. But I take issue with that phrase, recovering U.S. auto sales, because I just don't see that in the data. The Detroit-based firm, best known for vehicle lending, said profit for the first 3 months fell 56% to $129 million. How are you going to talk to me about recovering auto sales when the biggest auto lender in the country sees their profit cut in half versus a year earlier? Does that sound like an industry that is in recovery? Ally cited lower net financing revenue, a higher provision for credit losses, pay attention to that one, and higher non-interest expense. Now, I had to go digging for what those provisions of credit losses were because this article didn't mention it, but they raised their provisions for credit losses by $61 million to a total of $507 million. So that's up 14% year over year. Not a huge increase in provisions for credit losses. But you know what? We've seen the charge-offs and the provisions for credit losses. The banks have been kind of playing games with those this quarter to try to make their earnings look better than they really were. And when your earnings are already down by more than 50%, the temptation to underreport your provisions for credit losses is going to be pretty powerful to keep your stock from collapsing. So that's something to keep in mind here. Ally's net interest margin came in at 3.13%. That slightly missed expectations of 3.14%. and was down from 3.5% a year earlier. So we're seeing their margins are getting squeezed. That's the same thing we've seen at the other banks. The number of loans they're issuing is not rising enough. They're having to pay out higher interest in the form of interest on deposits. So their margins are getting compressed. We saw that everywhere from Ally Financial here to JP Morgan last week. Ally previously said net interest margin for the full year is expected to be between 3.25% and 3.3%. So we are pretty far cry from the net interest margins that they forecast. Auto sales have been coming out of their pandemic slump as inventories return to more normal levels. Yeah, inventories, that doesn't mean sales are going up, but the outlook is clouded by rising new vehicle prices, falling used car prices, and interest rate hikes, according to Bloomberg Intelligence. U.S. consumers have mostly used up their pandemic-era savings, and Ally has sought to remain prudent about extending credit to borrowers with weaker credit amid a record flood of applications. Tell me again about how it's all just bad economic vibes. How are you going to tell me on one hand your problem is bad vibes, and then at the other hand you're going to say, well, the savings is gone and your credit sucks, but the problem is your vibes? Okay. All right. That makes sense. Ally stock is actually up on this news, 3.8% higher. I guess the market was expecting even worse, trading at 37.65. That is just a few minutes ahead of the opening bell. Also showing some bad news in the auto market is in Europe across the pond this morning. European car sales drop in March as EV weakness persists. There's that EV bubble popping again. Many countries have reduced or halted generous subsidies. Germany, Sweden, and Norway post declines in EV registrations. Passenger car sales in Europe fell 2.8% in March as automakers, including Volkswagen and Stellantis, faced weaker demand, particularly for electric vehicles. New vehicle registrations dropped to 1.38 million units last month. The European Automobile Manufacturers Association said on Thursday, sales of battery-powered cars fell 11% as demand in Germany, Sweden, and Norway cooled. Pay attention, all you Tesla stock owners there and you Rivian guys. EV sales in Europe, where they were heavily subsidized, down 11%. That just goes to show you, without subsidies, this industry would not exist. The decline, due in part to the timing of Easter, is the second in 4 months and underscores the pressure car makers face amid higher interest rates, weaker economic growth, and the phasing out of generous subsidies to stoke demand for EVs. Also, bad economic vibes taking their toll on auto sales, apparently. Volkswagen, Mercedes-Benz, and Tesla have all reported lower EV sales in the first quarter of the year. So autos, again, more trouble in the auto market. Now let's shift over to semiconductors and the AI mania. Tesla expects Q2 sales to jump on insatiable AI demand. You just cannot satiate that AI demand. Taiwan Semiconductor, the world's largest chip maker and a major Apple and NVIDIA supplier, forecasts second quarter sales may rise as much as 30% as it rides a wave of demand for semiconductors used in artificial intelligence applications. And I love the way Reuters is just rounding up because the actual wording on the conference call was low to mid 20% range, not as high as 30%. That's Reuters just decided we're going to round up to make AI sound more insatiable, apparently. The surging need for processors for AI left executives at Taiwan Semiconductor Manufacturing Company, which investors watch closely as a bellwether for the chip industry, plainly stating just how strong the demand was. Almost all of the AI innovators are working with Taiwan Semi to address the insatiable AI-related demand for energy-efficient computing power, blah, 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 blah. AI servers are expected to account for a low teens percentage of its 2024 revenue. That's more than double from last year, with that figure rising to more than 20% of revenue by 2028. Now, that you got to be a little careful with the numbers here. They're not saying that AI revenue doubled. They're saying AI revenue's percent of total revenue has doubled, while the revenue in the other industries, smartphones and autos, is in decline as AI's is rising. So that's being helped at both ends. It doesn't mean AI revenue has actually doubled. It just means the share of the pie has doubled. Demand for auto chips would fall this year compared with previous estimates of growth it added. There's that trouble in the auto industry. Looking ahead, Taiwan Semi said it expects business in the second quarter to be supported by strong demand for its industry-leading 3-nanometer and 5-nanometer technologies, although that strength would be partially offset by sluggish demand for smartphones. So you got smartphones in decline, autos in decline, AI is insatiable. So net result, Taiwan Semi's revenue up 16.5% year over year. Their profits are up about 9% year over year, and their revenue guided to the low mid 20% range in increase. So those numbers are good, but they're not great. All right, because keep in mind, guys, the growth numbers, multiples, ARM Holdings trading at 1,200 times earnings. You need better than 20% growth to maintain a mania, to keep that bubble inflating. And right now, the stock market isn't seeing that. Take a look at Taiwan Semiconductor stock. It's actually down 4% on those numbers. Well, demand for the AI chips may be insatiable, but demand for Taiwan Semiconductor stock is not. That stock is down pretty big this morning. And again, after yesterday with the ASML stock and what happened on the news of semiconductor manufacturing equipment sales being down, all of those AI stocks sold off pretty hard. Well, they're not really participating today. They're not reversing those losses on this seemingly amazing report from Taiwan Semiconductor, you know, the insatiable demand and all that other stuff, but not enough to reverse that trend this morning. Now let's shift over to real estate and the housing market. D.R. Horton stock rallies as limited home supply boosts profit and sales. Look, I know you guys are waiting for those home prices to come down. You're sitting on the sidelines and you want to buy. You're sick of renting, but you're just going to have to keep waiting if that's you. The value of new home orders jumped 17% to top $10 billion for the first time. Shares of D.R. Horton rallied Thursday after the home builder reported fiscal second quarter profit and revenue that rose well above expectations and raised its full year outlook as the continued lack of housing supply helped to boost sales. Revenue grew 14.2% to $9.11 billion, well above the FactSet consensus. Number of new homes ordered rose 14.3%, while the value of new homes ordered jumped 17.4%. And well, when the value rises faster than the number, that means the average price is rising even more. The result implied an average price for new homes ordered of $381,766. That's up 4.8% from last year. Pay attention to that 4.8% increase because we're going to see that number again in just a second. D.R. Horton stock up 5.25% ahead of the opening bell, trading at $153.35. So home builders continuing to do very well here. And it's not just the new home builders. We're getting similar data out of Redfin here. Redfin reports the cost of buying a new home hits a new record as mortgage rates jump and prices rise 5%. In other words, if you couldn't afford things a few months ago, it's even worse now because this is affordability. Prices rising, rates rising, both rates and prices rising faster than wages means homes are becoming less affordable. Unsustainable is the word that comes to mind, and yet it persists here. The median U.S. home sale price increased 5% from a year earlier during the 4 weeks ending April 14th to $380,250. That's just $3,095 shy of the June 2022 all-time high. And guys, in June of 2022, I don't have the direct number in front of me here, but the average mortgage rate was like 3%, 3.5% in June of 2022. Now it's 7.5%. And the prices are basically unchanged between those two differences. And we're just $3,000 below the peak price that we saw in 2022. That's according to a new report from Redfin, the technology-powered real estate broker. The average daily mortgage rate this week surpassed 7.4%, the highest level since November after hotter than expected inflation report and the Fed's confirmation that interest rate cuts will be delayed. The combination of high mortgage rates and prices have brought home buyers' median monthly housing payment to a record $2,775 a month. That's up 11% year over year. If you're looking for shelter inflation to ease, if you're looking for home prices to have a downward impact on inflation, and maybe that's going to happen for a couple of months, but right now, home affordability is rising at a rate nearly triple what wages are doing. That's telling me inflation is going to get worse. That second wave of inflation on the horizon, there it is for all to see. Home prices up 11% year over year. Well, if you're one of those speculators buying homes to rent them out, you're going to have to raise your rent in order to keep up with that increase in the monthly payment. 11% year over year growth in home. That's not home prices. That is home payments. A lot of that is rising interest rates as well. And we've also got this one. Here's your bad economic vibes, all you millennials on Bloomberg. Budget hotel vacancies top 50% as inflation-weary Americans cut back on travel. Oh, the problem is their vibes. You could travel more if you just had a more positive attitude. Apparently, that's the message here. More than half of the rooms at budget hotels nationwide were vacant during the first 3 months of 2024 as inflation-battered travelers cut back on spending, according to the latest data from the hotel industry. Hotels like Econo-Lodge, Days Inn, Super 8, and Shore Stay posted occupancy rates of 48.7% in the first quarter. That's down 5% from a year ago, according to the preliminary first quarter from STR CoStar, which tracks the hotel industry. The 51.3% vacancy rate has led to revenues per available room dropping 6.5% from the same period a year ago, the largest decline among all hotel segments. Now, watch as you increase in the what's the word I'm looking at? As you increase in the quality level, as you increase in the expensiveness or priciness of the rooms, watch how these results get better than better. The results are weaker than we thought, said Jan Freytag, National Director of Hospitality at Market Analytics. Mid-scale hotels, the next level up from economy, that include chains like Best Western, that saw revenue per room drop 4.5%. So the slightly more expensive rooms aren't down as much. Upper mid-scale rooms declined about 2%. So they're actually doing even better, the upper mid-scale rooms. And at the other end of the spectrum, luxury hotels suffered just a 0.3% revenue drop, while upper upscale and upscale lodgings actually increased 3% and 0.4% respectively. So what do you get when you take all of this together? The lousy rooms, right? The Roach Motel rooms, they are way down, half empty or half occupied if you want to be an optimist. And then as you slowly move up in class, the declines get better and better until all the way at the tippy top, the most luxury rooms, those prices are actually rising because of inflation. Inflation hurts the poor and benefits the rich, and you can see it in their travel patterns. The rich are traveling more, everybody else is not. Everybody else is traveling a lot less. There's your bad economic vibes. And Mr. Freytag sees it too. He says, we are seeing a bifurcation in the U.S. lodging industry where higher-end hotels continue to perform well from increases in corporate travel and continued healthy demand from high-end leisure travelers, while people in a specific income level are traveling less. It's just bad vibes, guys. I'm telling you, it's just the vibes. The problem is you. It's not the economy. And I just want to say thank you so much. Where are you guys in here? I am a little backed up here this morning. Thank you, Alex Lieberman, who gifted 10 Nobody Special Finance channel memberships. I appreciate that, Alex, very much. Thank you for supporting the channel. And guys, if you received a membership from Alex, be sure and say thank you in the comments below. I appreciate that, brother. And thank you, Mr. Joey Socks, a.k.a. Paulie Walnuts. He says, for a well-deserved Wawa coffee, tell me you're from the New Jersey, Pennsylvania area without actually telling me. Wawa, the very ramparts from which we defend our idle lifestyle. Yes, I am a child of Wawa. Many a morning I got my Wawa coffee and a light bulb sandwich from the Wa. Good stuff there. And thank you, Joey Socks. I appreciate that very much. And thank you, Steve Boyda says, compared to ICE vehicles, any idea what the percent of new price the resale value of EVs are? ICE being internal combustion engine vehicles. I don't have that data. There's not very much data available about used EVs. I can tell you anecdotally, I've heard from a lot of people that say used EVs are a big problem because those battery lives, there's a big question around the battery life. And to replace a battery in an EV, you might as well be buying a whole new car. You got to take the whole car apart to replace the batteries. That's a big question mark. And I think that really suppresses the value of electric vehicles. I've never gone and shopped for one. It's probably a pretty good question for my buddy Tommy. Maybe I'll have him on the channel. There's a lot of auto news. Maybe I'll bring Tommy from Car Concierge Plus back on the channel again to talk about this one. But from everything I've read, I don't have data. I only have anecdotes. EVs don't hold their value as well as internal combustion engines, Steve. Again, I don't have the numbers to back that one up. So take that with a grain of salt. But from what I've read, the used car guys just don't want them. Thank you, Steve. I appreciate the super chat and the support of the channel. And thank you, Nashville Pasta Man says, you know what doesn't need subsidies? Pizza. That's right. Let's get the Pizza Act. We got to come up with an acronym for pizza. I don't know, finding two words that start with a Z. You're going to have a hard time there. But no, we don't need to subsidize pizza. Pizza sales are doing just fine. That's one of those comfort foods. Maybe pizza sales even increase during times of economic turmoil. You know, it's kind of like women into makeup during periods of high unemployment and economic turmoil. Makeup sales actually go up. It's kind of interesting because it's like, oh, everything else is going to shit. I might as well treat myself. Maybe pizza does the same thing. But we won't be subsidizing pizza anytime soon, that's for sure. Thank you very much, Nashville Pasta Man. I appreciate the super chat and the support of the channel. You, sir, are a gentleman and a scholar. And everybody, I just want to say thank you so much for having your coffee with the Melonheads this morning. I appreciate that very much. Thank you for the super chats. Thank you to all my channel members and magnanimous Melonheads for supporting the channel. I got links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.